because you haven't had to. When you put something on the market and you get 14 offers, you're gonna go with the best financial option there is. Cash, conventional, VA, FHA, right? You're not gonna get super creative because you don't have to. So today what we'll be going over is, I think it's 28. The last 8 or 9 or whatever, 10 or 11, whatever it is, are for maybe for lenders, so we're going to skip that part and we're going to just focus on the first 17, 18. But they are really good financial ideas to help get your buyers and sellers things accepted. I'm going to shut the door real quick because I'm easily distracted. I don't like the noise. We're going to jump into it. So in your books, Mike's going to be posting it online for you guys on Zoom, so you can click and download and follow along. They are about to bring them in. They take a while to print, and they didn't realize how long it was going to be to print. They weren't prepared. So they're going to do that, and they're going to bring them in. He's counting how many to make sure they probably have enough coming in right now. So in the book, it goes through a story for each solution. And the challenge of it, and then the solution and how it works. For the sake of time, I'm not going to be deep reading into all of the each one, but this book's really worth keeping and reading if one looks interesting to you and you truly want to understand it. So we'll talk about it as a group, and I'll be completely transparent. Some of them are new to me even. I'm like, oh wow, that's smart. I didn't think of that before. So I haven't done most of these. And it's not for you to do 100%, it's going to be for you to talk to your lender to make sure it does work. In fact, when I was reviewing this, I already talked to my lender, and he's like, yeah, I heard about this, and we started talking, and I'm like, this is a great gopher, we're going to run it, and I'm going to run something next week just to kind of prove the point that there's great ideas out there, you just got to get creative with what you're going to do. So with that, let's get started. The main ideas for today are going to be the overview, what sellers can do in a changing market, what buyers can do in a changing market, then what lenders can do in a changing market. The lenders we're pretty much going to skip. If you want to read through those on your own time, you can, just for the sake of time, but none of us in here are lenders. So most of those things, it would be good to know, because then you could talk to your lender about these options, and like, hey, can you do this, or is this an option? And that might spark them to go figure out something that they didn't think of before. Sound good?
Sounds good.
As always, guys, please interact. Let's talk together. I don't like hearing myself talk for an hour to make this more interesting. All right. All right, we're going to skip to this page real quick. At the top of your booklets, for those of you that have it already, and if you, Mike should be posting it any second online, you're going to see on the pages they have a little symbol. It's the IAC symbol, and it highlights it. Basically what it's doing is telling you what would work during this solution. So I is for income, A is for asset, C is for credit. So for the first one, for example, is seller's contributions, right? And that is an A for an asset. And it says right at the top, it has highlights with an A. All right? So let's jump into it. So this one is actually one of the most common ones, right? Who's here done credits before?
Yes.
Right? Credits are common. So it was a lot more common a couple years ago, but what's a credit?
Some money given to the buyer from the seller.
Yeah. Right? The seller's crediting the buyer some money to help get the deal closed. So the challenge, sellers being transferred, needs to sell within 60 days, price at $250,000. The seller agreed to pay for buyer's closing costs. This is one of the most common credits, happens all the time. You might write an offer for $300,000. So roughly we know that closing costs are about 3% from a lender. So a lot of times they're less, but roughly we know 3%. So if it's $300,000, we know it's about $9,000 in closing costs. All right. What changes that? What can make that different?
The FICO year.
What was that?
The FICO year.
So where it's at in the year?
Yes.
Yeah. Right. Why does it affect where it's at in the year?
Because of taxes.
Yeah, you prepay your taxes. So if you're right where the payment's due, you have to pay the seller back their credit, the taxes for the month's difference. So you might only have to pay them $400 if taxes are due in the following month. But if taxes were just paid and it was $2,400, well, you might have to pay that full amount, right? So your taxes, what time of month it is, what your closing costs, what your lender, it changes, right? But we just know roughly 3% will cover typically what we do. So giving someone an offer, asking for $300,000 and you're willing to pay the full amount, but the buyer needs closing costs, right? A seller might be willing to do that. Super common, happens all the time. There's nothing too exciting on this one. If you go through the page on 14, it kind of gives you the solution, what's going on. When trying to move property quickly, one of the first consideration is going to be the price. The second might be the seller's contribution. So sellers sometimes get in their head, like they want to make a certain amount. Like, I gotta make this amount. I gotta make, blah, 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 to make it worth it. I want to make $300,000. I don't want to make anything less more than $300,000. Well, if you write an offer for $309,000 and asking for 3% back in closing, the seller still nets the same, correct?
Yeah.
What's that do to the loan?
That's finance or closing costs?
It's finance and closing costs, but what does it do to your loan payment?
Increases.
By what?
A little bit.
Not even that. It's like $15, right? $12. So a buyer might be willing to do that to save the $9,000 up front. But what's the risk?
Losing the buyer?
The loan not being approved.
The loan not being approved, why?
Make an appraisal.
The appraisal, right?
Oh, right.
So if you're going $9,000 above what they think it's worth, there's always a chance the appraisal doesn't come in. Now you're back at negotiating. If say the appraisal comes in at $300,000, the bank will not loan on the house for being $309,000. So now you have a $9,000 gap you have to negotiate, right? And if the buyer desperately needs closing costs, they can't close. Hopefully the seller comes down. They do a lot of times. Sometimes they don't. You can lose the loan. That's the risk, as long as everyone's aware, but it is a good strategy to get your offer accepted with buyers if you're needing closing costs. Especially now when the stuff's sitting on the market, a lot more common when that's happening.
Doesn't the appraisals for the most part just kind of match what the loan is?
No.
No? It
Depends on your appraiser.
Got it.
Appraisers are deal killers. Sometimes appraisers think that God put them on this earth to make sure that house is exactly what they thought it was. I've had appraisals come in $2,000 less, $1,000 less, and you're just like, why, dude?
Yeah.
Give me the $1,000. Now I got to renegotiate $1,000.
Right.
Right? It doesn't kill the deal. It's just a pain in the ass.
Got it.
And it depends on the appraiser. Sometimes you get appraisers from Orange County. They come down and they see Quartz Hill and they go, well, they don't know, right? Well, they don't realize Quartz Hill is an area that's desired. A local appraiser will know. They'll give value for that, but someone down in Orange County might not. So you don't ever know what an appraiser's going to do and what they'll call out and other appraisers don't call out. So appraisals to me are the scary part. I can handle inspections. I'm pretty good at preparing my people with appraisals without what's scary. All right, so seller contributions, that's super easy. We all know that one, right? Well, some of us don't because we're newer, that's okay. But the seller's contributions, you could read through those pages to kind of understand it. All it's saying is the seller contributes towards the buyer's closing costs and what they can do. Seller funded, number 2, seller funded permanent pay down. Buy down, not pay down. All right, so back and forth. So who knows what this is?
The
Just
point.
buying down the rate.
Buying down the rate through points. So this hits home right now, right? Why are so many buyers nervous right now?
Interest rate.
Interest rates are going up really high. If I'm selling a home right now, what might be a good offer I might do?
Offer to buy down their interest rate for a point or two.
10.
Yeah. Being willing to, maybe the seller's willing to buy down a point or two, maybe 2 points. What is 2 points equivalent to on their loan?
2%.
Not 2%.
1%.
So 1 point is about 0.25 on an interest rate. So 1 point's about 0.25% of an interest rate. So if you're going to buy down 2 points, you're buying down about half a percentage of interest rate. That makes sense?
Yes.
So we could actually look at this in our, on page 22, it'll even show you what your half a point does to a point, to a half a point to 2 points. and it'll show the monthly payment, right? And so your MOFR could be seller funded permanent buy down saves you $28,000. If they're willing to do a $5,000 buy down on a $250,000 home, that's 2 points. That saves them 0.5%. 0.5% over 30 years saves $28,000. So you see, you get people interested, you save them 0.5% of interest rate. It does lower the payment quite a bit, almost $100, right? $100 a month, that might be enough to get somebody into a home that doesn't qualify. This is the loan to value. So this right here is a great strategy if you're looking at interest rates being high and you're trying to think of a way to sell a home to get people interested in, like, oh, that 6% is too high. Well, would you do it at 5.5? Well, maybe. Or right now, what are we at today? I don't even know. Does anyone know what we're at today? They've been bouncing around like crazy.
Yeah.
Probably high fives.
5.5 or a little bit over.
4.
Is it 5.4 today? That's low, lower than it was. I was thinking it was more the 5.75 area. So if you can get down to 0.5%, get it closer to 5, that's pretty, right? $6,000 for a $300,000 home, $8,000 for a $400,000 home. Maybe even do $10,000 down instead of doing a price reduction if your seller's willing to do it. If you have a house sitting on the market right now, and it's been sitting on the market for let's say, a month and a half or 2 months, and you're not getting a lot of activity. Maybe instead of them lowering the price, how do you write that into the RPA? So in your additional financing question, and Christine, in your additional financing on page, what is it now? Page, I don't remember the page. On your first page of the RPA at the bottom, there's additional financing. You say seller to contribute what it would be, whatever the amount towards buyer's. What is the exact wording?
Non-recurring or?
No, that's closing costs. Recurring and non-recurring is closing costs. It's to buyer's buy down of mortgage rate or something like that. Christine, I'll have to get back to you to get the exact wordage on that to be legally correct. But yes, basically you're asking for the seller to contribute $8,000 to a buyer's buy down of interest rate, like to pay down the points up front.
You said each point is a quarter.
Each point is a quarter overall for the interest rate.
Mm-hmm.
So if you were to buy down, and the reason why lenders will do that is they'll take the money up front. They're going to make their interest up front, they'll take it, and they're going to sell the loan off anyway, so it makes sense for them, right? On almost every one of these, you've got to talk to your lenders to make sure they are on board and they can do these things, right? It's up to the lender, it's not up to you to make these things work. But anyways, it's a great way to kind of motivate, because if you're talking to a seller and they're unsure they want to sell, right? Or they're unsure they want to lower the price, or maybe they're like talking about lowering the price. Well, let's try this first. Let's see if we can generate some leads this direction and see how that looks. That make sense?
Yes.
Do we have clarity around this? Some of these are going to get a little confusing, so I just want to make sure we have clarity before we move on. You can read through the booklet and truly it gives you a full breakdown and understanding of it, but for the sake of time, we can't read it together on here. All right. Seller's permanent buy down. It's a great. You can even read the snapshot, and it'll kind of give you a quick snapshot of how it works at the end, and then little examples of why. All right, so this one's probably one of my favorites that you can talk to your lender, and your lender's going to go, let me ask, because I don't know, I haven't heard of that unless they've been a lender for a long time. It's a seller-funded temporary buy down. All right. So the temporary buy down is different than the permanent buy down because it's just what?
Temporary.
Temporary. So the challenge is the stagnant market. Enticing buyers is difficult. Buyers are focused on interest rates, which buyers are really focused on interest rates right now, right? So what if I was to offer them, hey, buy this house for 4% interest rate your first year? That might get some leads. That might get some people interested. Right? I can afford 4% this year, and I'll make more money next year, and I'll be able to go to 5%, something like that. So a temporary buy down is basically what you're doing is you're taking the interest rate. Let's say right now it's a 6% interest rate for easy math. They call it a 2-to-1. So your first year you'll be at 4%, the second year you'll be at 5%, and then you'll be at 6% for the remaining or the remainder of the loan. Why would a lender do this? Well, it's to get people into the game. Right? But the seller is going to have to pay for the difference up front. So how do you figure that out? You take 4% interest for the first year and see what that is. All right? So basically you take the payment of the loan, you see what the interest is on that payment of the 6%, and see what that is on 4%. All right? Then you see what it would be at 6%. Then you do the same thing for the next year at 5% and 6%. And you take the difference of that number, and that's the credit that would be applied to the seller. The seller would apply to the buyer to pay down the rate. So there's examples of this on page 28 and 27 and 28. There's a really good example somewhere now, I'm not seeing it.
28.
It is 28? Okay. So basically what you're doing is taking that lower rate, the annual savings over the year, and then you figure out what that difference is, and on this example it would be $5,532. So the seller would credit $5,532 to the buyer to pay that down to the bank. And the bank would do that because they still make the same amount. They make the difference in the interest. It's to get people in. So it's called the seller-funded temporary buy-down. I was talking to my lender about this morning because I think this is a great move. I think this is a great way to generate leads right now.
When most of the lenders just call it a 2-1 buy down?
That's exactly what it is. It's a 2-1 buy-down. Some lenders even offer a 3-2-1 buy-down.
Similar term.
It's a 2-1 buy-down. So he was around when those were happening. Most of us weren't, right? There was no need to do that because you had 9 offers, right? But now if you have something stagnant for a while and you could offer an interest rate of 4%, I'm trying to read that Zoom.
It says thank you.
Right? It's a great way to get people interested. 4% for your first year. It's a 2-1 buy down. Do we understand that one? Does your brain start clicking for ideas?
So we'd be educating our buyer or talking with our lender to say, hey, this is offered, so that when we make the offer to a seller, we can...
So the first thing you would do is talk to so if you're a seller, right, you're going to talk to your lender first, your trusted lender, and say, hey, if we offer this, do you have a 2-1 buy down? Do you have that type of program? And if he's like, no, I have no idea what that is, well, can you ask? Because a lot of times they might not know because they haven't done one. Doesn't mean they don't have it, right? And if they don't have it, you might want to talk to another lender that does, right? So when I called my lender this morning, I was like, hey, do you guys do this? He's like, yeah, it is coming back. We haven't done them in a while, but we do have that now. We do have that, offer that. Great. So they offer it. So now if I have a listing and I want to sell that home, I might get into this home for 4% interest rate or something like that. Now if the buyer reaches out to me, someone reaches out to me, they're gonna have to talk to my lender, right?
Okay, that's what I was going to ask. So you can have a lender lined up even with the seller.
Absolutely.
So
yeah, you're trying to find that buyer.
For buyers that come in that don't have, I guess, pre-qualified, they can use a lender already set up for the seller to complete the deal, in a sense.
Gotcha. Yeah. So you're always trying to find the buyers for your clients, and you want to have a lender lined up for when those leads come in. That here's the leads getting qualified to buy the home, right? And you might have people call that have a lender. They go, but I want that program, right? Okay, great. Talk to my lender. Here it is. And so if you're on the buyer side, you could then ask your lender, hey, is this something you do? And then that would be something you have to write in an RPA and talk to the listing agent before to say, hey, is this something that you guys would be willing to do? It's basically it's a credit. The seller's just crediting the buyer. They don't care where the credit goes, flows into this or that. Whatever's going to get the deal done, if they're willing to credit. Make sense?
Yeah.
But when you're explaining it, you want to make sure you understand it, because otherwise, Christine said, you have to run it by me again. Christine, we can talk offline too to truly break it down. But you could also talk to, what's her name out there? She probably has a way that they can do that.
Carol?
Not Carol. She's in Ridgecrest. Tanya?
Oh.
There's, we have a lender in the office. For the life of me, my brain doesn't want to work right now. Okay, so the seller-funded temporary buy-downs. We got a good, somewhat grasp of that? Somewhat?
Yes.
Makes sense? We're gonna try to all we're doing right now, guys, is getting creative. Because in a market where the houses sit, you have to get creative to find buyers and sellers. Owner financing. Owner financing. Beautiful. So you go to take a listing. The owner owns it free and clear. What are you gonna ask them?
Would you consider carrying a loan?
Cash.
Would you consider carrying the note, right? What does that mean?
They're the bank.
They're basically the bank. They're going to sell the home, but they're gonna act as the bank for an agreed upon down payment and an agreed upon price through monthly payments. When I bought my house, my uncle owned it. I called him, I said, hey, you wanna sell me your home? He said, if I could carry it. I said, hell yeah, let's do it, right? So he makes an interest rate off me, I pay him directly, right? I can still write off the interest at the end of the year. It's everything just like the bank, I just pay him directly, right? What are some benefits of that?
Long-term income,
Lower interest rate, potentially.
lower,
But lower interest rate, easier, I mean,
fixed.
my uncle had to approve me, right? And he goes, you're approved. I didn't, right? It's not like I'm getting
No
underwritten.
paperwork, really.
It is a nice, easy way to do it. We agreed on a $15,000 down payment. We agreed on an interest rate. We went to escrow, we closed it, right?
And also help if your
Super
offer accepted too, right? It's more of an incentive for the seller as well.
Well, for the seller, right, he's gonna make, so he sells the home, he's gonna make a 4% interest rate over the life of the loan. Do the math. Makes an extra $100-something thousand, 150, 100, I don't even know what it is off the top of my head. But he's gonna make, instead of selling the home at the time for about 300,000, he's gonna make 450 over the life, right? Make a lot more money on interest over time.
There's risk though if they don't pay.
There's risk. What's the risk? They don't pay. Now, he has to go through the foreclosure process to take the home back. He would have to fight those legal battles. They would have to do that, right? So it's risk versus reward. It's absolutely risky to do it, especially if it's people that you don't know or anything like that. And how do you qualify them? There's a lot of concerns with that. But it opens up the door to a lot of options if they are willing to carry it. That make sense?
Yes.
Especially if the house is, maybe not loanable. You ever walk in a home and it doesn't meet the minimum criteria and they don't want to put money into it, but they own it free and clear? Okay. If someone's willing to go in there. All right, there's some good examples on those pages as well. I don't spend too much time on it. All right. Contract for deed. Does anyone know what this is?
No.
So a contract for deed is similar to buyer carrying. But basically what the difference for it is the owner is gonna own it until it's completely paid in full. And once a contract is complete, then the owner will transfer over the deed.
That's more safe.
Oh, they don't do that in the other one? And there was.
So the other one, no, they transfer the deed over. It's sold, but you have a note on. You hold the note, meaning that you have a mortgage against the property, so you could
So you
take
can
it. Yep,
foreclose.
you can
Oh, okay.
foreclose and take it back.
Got it.
This is the owner keeps it until all the way through the process, and then they take it back, or then they give it over. Right, once it's been paid in full.
Technically, they're renting it, kind of.
Kind of, but there is a contract in place that once it's contracts out, right? Now, let's be real. Like, this is one that's very rare, right? It would be hard for me to want to do this. What happens if there's 30 years over the life, right? There's more risk there. But what it's like, the benefit of this is if buyers can't be approved. There's something that you want to do, you want to help them out. Someone knows somebody, they want to make it work, right? They may be able to make this work. It's an interesting one. I honestly don't know. It's an option to have in the back of your arsenal. It's a contract for deed. And you want to make sure, A, it's legal in your area. Some areas they may make it illegal. I don't know locally what the rules are around this. But it's a unique idea, especially if they said for unique properties that are really hard to maybe sell or not the most common thing. And someone's willing to, hey, I'll take it. I'll pay you $1,000 a month, over this 20-year period, and at that time the deed is yours.
What happens if the owner dies?
So that's all gonna have to be in the contract to make sure what happens exactly, right? Because really then it goes to the estate and you still have to pay the estate, you have it in contract, and when it closes, you would still get it, right? And if the buyer was to die, I believe someone would be able to assume to take over that. But once again, this is, you get lawyers involved in writing out these types of contracts because you aren't gonna find a contract to deed in the car, right?
I would say that's how I bought my house, was a contract to deed. So he's holding the deed, and then what happened with mine is that it was when the people were doing like short sales and stuff.
Uh-huh.
So the house was 126,000, and then I just stepped in. He's holding the deed. It's a 30-year. In the meantime, he's divorced his wife, and she stopped making the payments once. She was the one that's in charge of the payments. So we didn't find out till we're like 3 months in. He caught up the payments though, bought her out, and we continued.
That's.
But there are risks.
There are risks, right?
And she was getting letters, so it was.
Yeah.
We didn't know.
But then it was a good opportunity for you at the
Oh,
time.
yeah,
I'm
sure, yeah.
Yeah, you saved probably a ton of money getting
Yeah,
it.
10 years in right now, so.
That's awesome.
Are you able to claim interest or no? No, okay. It's not, you're not on
But I know
the deed.
some contracts you might be able to.
Yeah, that's a good point, because, I mean, is he charging you interest?
We have a set fee, we just pay that
Yes.
per month, so
Yeah.
it's almost like a lease.
Yeah. It's almost like a lease.
But it's in the
home.
contract, the deed's at the end, everything,
Yep.
so.
So you wouldn't be able to sell it hypothetically?
I can rent it or lease it at any time, but I can't sell it without he has to sign off on it.
Yeah, and if you do sell it, as long as he is, typically there's a buyout clause, so as soon as you go to sell, he has to pay the note in full.
Correct.
Right? So as long as he approves and he's good with it, and like, I'm sure the house is worth 4 times the amount that he
Yep.
bought it for,
Yep.
and everyone's good with it, you're good to go. But it's, that relationship is always there now.
Yep.
Which is most of the time your relationship's done. I mean, really, in theory, with my uncle, as long as I paid him all the time, I would never have to talk to him again and on the owner carry, because the relationship is a payment, and I just send it to him, right? That's it. And if I don't pay, he forecloses. The house is mine to do what I want with. But any other questions on that? Tiffany, that's her name. Thanks, Christine. I could not think of Tiffany's name for the life of me. She's in Ridgecrest. She's the lender out there. All right, contract to deed. All right, next one, seller's second. All right, so this one's a little interesting as well. So the challenge is the loan to value, right? So we all know what a loan to value is, right? Loan to value on the home is what the loan on it. Lenders make loan based, among other things, a concept known as loan to value, LTV. The sales price of the home is $250,000. The amount is $200,000, and the loan to value said to be 80% because the loan equals 80% of the value of the sales price. All right? Well, sometimes, what happens if we don't get 80% down? What's something that will trigger that we'll have on each loan?
Mortgage insurance.
20?
Mortgage insurance. If we don't have 20% down on the home, they require mortgage insurance. That way, if you default on the loan, the insurer will cover it, right? We don't get ourselves into trouble like we did in 2005 and 6 and 7 and 8, right? So mortgage insurance is triggered, and that adds $150, $200 a month almost to the payment, right? So a combined loan to value, so basically what they're doing is a seller's second is basically giving a loan to the buyer for the amount of the difference to make up to make it 20%. So if you go to page 47, it's a good example. So let's say the sales price is $400,000. The buyer could only afford 5% down. So the loan is $380,000. The 30-year loan at 6.5% is $22,401. The PMI is $160 a month, so the total payment is $2,561, right? Now flip that over. If you were to do, the seller was to do a second. So basically, the sales price is $400,000, 5% down, 80% loan to value. The seller does a second loan at $600,000 at a 7% interest rate. The first loan is now worth $2,022 a month. The second loan that the seller is going to be paid by the buyer is $419, and now their monthly payment is $2,441. That's $120 cheaper. So basically what this is saying is the seller will go, okay, buyer, I will give you a $60,000 loan that you can do as your down payment, and I'm gonna get 7.5% interest rate on that. So if I'm selling a home and I make, say I own it free and clear, I'm making $400,000, I'm willing to risk $60,000 of that to get a 7.5% return on interest and help the buyer get into the home easier with a second. Does that make sense?
Yeah.
So it's creative financing here to make the buyer's payment lower. The seller's risking a small portion, not doing the full thing themselves, just a small, 60,000 compared to what it could be. Now the buyer's in cheaper, they have a lower rate, they're not paying PMI, they're paying 2 payments a month, but it's still cheaper.
Is this an unsecured debt, or is it attached to the property still?
It's still attached to the
So
property.
they can foreclose on it? Okay.
You're a second position though. So being in the second position to foreclose, or your third position, taxes are always first. Then the first mortgage, you would be the third or whatever that is. So yes, there is risk, there's always concern, but basically they're putting a second on there. Obviously the bank would have to approve, it has to go through, and the lender would have to approve, and these things, not every bank's gonna do it. I guarantee 100,000%, refinance is stopped. Banks made more money they've ever made the last 3 years, and now they're going, uh-oh, they're gonna get creative. They want loans to go through because they need to make money. So they will start looking at stuff like this and think this is an option. All right? So basically, you're getting a second loan from the seller to pay down that cost. Do we understand that? All right. We're just arming you guys with knowledge here for ideas, because this stuff's a little out there, it's a little different. I would have never thought of this, and it's so brilliant and so easy. I would have never in a million years thought of it. Lease with an option and a lease to purchase. So this is similar to the note to carry, not note to carry,
Contract deed.
contract to deed. So a lease with option or a lease to purchase is kind of the same thing. Basically, what a lease with an option means that I'm going to agree to lease the home for 1 year. At the end of that, I have the option to purchase the home. A lot of times that option will include your first year's payment has been, or your down payment has been a part of the lease payment, depending on what is agreed upon, right? And lease to purchase is almost the same thing. I think the only difference is the purchase is it's already guaranteed. The option is, hey, you have the option to do it. You don't have to. If not, it's been farewell. See you later. Or we'll move in. We'll figure it out. A lease to purchase means that the first year is you're buying the home. I'm going to purchase it. The first year is a lease. Maybe that goes to my down payment. Maybe it doesn't. Whatever that looks like. After that, I'm buying the home. This is what it looks like. The money's due. Make sense? So what's some of the benefits of this?
Guess maybe the buyer is just not prepared at that time, or they're gonna get a raise or increase or something a year from that point.
Yeah. I mean, maybe interest rates will be lower then. Maybe they can get in at a better time. Maybe they just need to save up some money. Maybe they want to make sure it's the right area for them if it's a lease option. And for a seller benefit, they're making money on the lease for the next year. They still get that asset. They see what happens with the market. Right now, if I was a seller, I probably wouldn't want to do that. Just being honest, unless they did a lease purchase and it was already agreed upon price. But then you have issues of appraisals and stuff like that. So it's just an option out there to start thinking through. All right, selling to relatives. This one's pretty simple. I mean, there's nothing here that's not a really thought of or anything before when it comes to this. But the difference between relatives and things that most banks won't allow is you are allowed to get a gift from a relative family member that doesn't put red flags when it comes to lending to be approved, right? My parents can give me a gift of $100,000, and that is okay for them to be approved now for me to go get that house. That make sense? If $100,000 shows up for me from some random thing, I have to prove where that money came from. And if I'm like, well, selling drugs, you know, it's gonna be hard for me to get approved. Right? Or I kept it under my mattress. This is actually a common problem. There is, especially in the Hispanic culture, people don't trust banks as much, and they keep their money in a mattress. Like, no joke, like it's a thing. And all of a sudden, like, hey, I got a ton of money. Like, I have 100 grand, and you're like, well, there's no bank trail. There's no, it's a problem. Because now they can't just put it into the bank is gonna have to say where'd that money come from. Like, it's happened to me. They're like, well, we don't trust banks. I'm like, well, I don't blame them. I mean, I don't trust anybody either. And now, good luck getting an underwriter approved that $100,000 that just showed up, right? It can be a challenge. So these are real things that do come up. So a relative is allowed to give that gift right here, and it'll be approved. Wraparound mortgage. Who's heard of a wraparound mortgage?
I have.
Heard of it, right?
I don't know what it means.
Most of the time it's illegal. Probably not going to happen, but you never know. So basically what a wraparound mortgage is, let's say I bought the home last year. I want to move. I'm going to keep paying the payment as the seller. The buyer is going to come in and pay me to pay the payment.
What?
So I own the mortgage. I have to pay the loan every month. I want to sell it. A buyer comes in, right? The buyer is now going to pay the seller. The seller pays the mortgage in the bank. The bank and the loan never goes away, right? Now, it can be very illegal if they try to do it secretly. So don't do that. Right? Like, oh, I'll just get it, I'll pay the bank, good. No, the bank has to approve, has to be a known thing, and then the seller might charge more, whatever that is.
It happens a lot, especially with family.
It could happen with family, but it can be very illegal.
It seems like renting. I think it's a lease.
It is, but now you're the owner. You're actually going to transfer title.
Oh, you transfer homes.
Right? So you can do it illegal or you don't transfer title, right? But so most of these don't happen. Most of this is not a solution. And it might be worth asking your bank, hey, wraparound mortgage is approved, stuff like that. It's just getting creative out there in the financing. So you've heard about a wraparound mortgage. It's a, not like crazy uncommon, but we just want to make sure that we understand it. So this is an example. It shows some of the positives to it. Home is listed $200,000. Home loan is $100,000. Current market is not good. Current mortgage rates is 5. Market rates are closer to 8. All right, buyer asks seller to consider financing the sale, but they can't because they have a loan, right? Well, this is an option where they could, right? They had $100,000 on themselves. They do the wraparound mortgage. They come to an agreement. They're going to keep paying the mortgage, and they collect extra money on the sale.
And a lender would do that because maybe that current seller is just in a better financial position, so there's like less risk.
Most lenders won't do it. Yeah, I don't. From my understanding, it's pretty. In a lot of places, it's illegal. It might even be illegal in California, where they don't want to do that. But it's good to know about it. If someone asks about it, you understand it. You can research it and see if it's even a possibility. Make sense? Kind of have a better grasp of what that means now. All right, what buyers can do. We're on number 10 now. These pages are all backwards. Using a 401k. So buyers, a lot of times, this happens a lot. Buyers want to buy a home. They don't have a down payment, but they have a 401k. Can they use it?
Yes.
Most likely, right? Not all 401ks are created equal or same. Some programs are great. Some allow you to use it for buying a home. There's no penalties. Most don't. Please don't be me. Please understand when you go and someone says you 401k, you go, great. Your next say is, have you talked to a tax professional to look at what that will do for your penalties? Because there might be a 10% penalty they have to pay at the end of the year. If they're going to pull out $100,000 and they have to pay a 10% penalty, they might not have it, want to pay that. It might be a 20%. I don't know. Right?
My first buyer just did that.
Did they know about the penalties?
No.
Well, they're going to have a great surprise at the end of the year. And boy, are they going to be happy with
I
you.
inherited the situation. I inherited it. She was like, I talked to my lender, we use a 401k. So then I'm like,
That's fine. I mean, at the end of the day, it's not your business, but it's at what happens at, it is your business. at the end of the day, it's their choice though. What happens a lot of times is they get close to the end and then they find out and they go, oh my God, never mind. I didn't know that. And that's where it sucks because you went through all this work and you could have prevented that. That's what happened to me. Got to the end and I just assumed. I'm like, yeah, well, you know, I'm like, are they gonna let you pay it back? They're like, well, what do you mean? I'm like, well, you pay it back, like, what, you're gonna have a penalty, or do they like, what do you mean? I'm like, uh-oh. I'm like, well, you gotta talk, I'm not sure, I don't know what your 401k is, but I just assumed that they allowed them to get the house for it. Go. Canceled escrow.
Oh, that's crazy.
So you can't just put your money out?
No, there's penalties. 401k you can't touch till you're 59 and a half. And every time that otherwise you incur major tax penalties.
Right,
The whole purpose of it is you have to put, it's forced savings for your retirement.
right. Or you can like take a loan against it and pay it back, but.
Some of them allow you to pay it back within 90 days. There's all sorts of things, but you have to know. They're all different. You don't know.
Why are you even touching that 401 money?
What appreciates better, 401k or home?
Home.
I don't know. Not always. I mean, it depends. Home's on average 4 or 5%, but if you're paying rent, if you're losing money paying rent and you can get a home that appreciates 4% over a year, over a 401k that averages 7% or 8%, well, it makes more sense to go get a home because you're saving a ton of money.
It
Right?
can also depend on the 401k, right?
It depends on the 401k. I'm not a 401k expert, but I
Right.
do know I've lost an escrow to not being a 401k expert. So it's just good to understand that these are great options to get people if their 401k allows it.
Now I'm stressed out.
It's, the lender brought it up to them and he took it over.
Right, is it already closed?
Yeah.
Give
Don't
them a
even worry
close
about it, there's nothing you can do about it at this
There's
point.
nothing, there's nothing you can do about it. It's closed, they pulled the money, they try to
We're
repair
done.
it. It's up to
That's,
them.
that's like, a lot of times it's a
You're
direct
done.
payment
They're
they
gonna
have to
come
pay
back
back,
and-
or it just goes.
Correct, the full amount.
Oh, okay, it's not
If
a
I borrow
tax.
$100,000 from my 401k, I have to put back the $100,000 within 90 days or there's major tax implications almost all the time.
Right.
A lot of times it's a 10 to 12% hit on the tax that you took out that year. So now they have to pay another $10,000, $12,000 at their taxes at the end.
Right.
Maybe they
Right, and
have
that's
another
counted as
ability
income as well,
where
too.
they gonna
So-
take the money.
Yeah, you never know. All right, temporary Ira transfers.
My first deal I got done, guys.
Congratulations. That's how we learn real estate.
But it's not his fault, is it?
Yeah.
So no, it's not.
So at the end of the day, he's a real estate professional, gets people to home. He's not the financing specialist.
Right.
He gets a lender for that,
Oh, okay.
right?
It's not your fault.
If I have to pay 12 grand at the end of the year, I would go, what the hell, why didn't anyone tell me? And I'm not gonna use any of those people again. It's gonna piss me off.
Right.
Especially that one.
Oh.
I'm just kidding, you came into it halfway, you don't know. All right, temporary, we gotta go a little bit faster, because timing, like always, you know me, I go on and on. Temporary Ira transfers, same thing with an IRA, right? If you have an IRA and you've been, an IRA and you've been saving up money, a lot of times they allow you 90 days transfers, as long as you pay it back. Because there's an old, I would encourage this, but people are like, hey, let's go to Tahiti, let's pull out 10 grand from this, go have a great time, as long as I pay it back within 90 days, no harm, no foul, right? Same thing with this, if I could pull out 60,000, use it as a down payment, and then I'm gonna have that money in the, somehow, I'm getting a big bonus or something, or I'm robbing a bank, and I can pay it back within 90 days, that's something I can use. Here's what some people do. Make sure that's not the next one. That might be, yep. So, let's say I'm a risk taker. I'm gonna pull out my 60 grand from my IRA. I'm gonna go get into this home. And as I'm doing that, I'm applying for an HELOC, a HELOC, home equity line of credit, to pay back my IRA.
Wow.
People do that. I wouldn't, but you could get credit. Right? If you could even get approved for a HELOC with not having any equity. I mean, but maybe you are buying a house as equity.
Right.
Buying a piece of crap as equity. And there's 60 grand in equity in the home. Well, you guys feel lucky. Can we get that in 60 days, 90 days? Right? All right. Appraisable assets for down payment and closing costs. Who here collects baseball cards?
Hockey cards.
Hockey cards. You got rookie Wayne Gretzky's signature,
Damn, I wish.
right? So anything that has a money trail, let's say you have, in the example they use in here, they have a collectible coins, right? Really expensive, nice coins. Say it's worth $30,000, $40,000. Anything that could be appraised with value, precious art, paintings, something that you could go get appraised for. If you could go sell that, get a chunk of money and show receipts where it came from, as long as it's a collectible art, you can use that for down payment. That makes sense. So sometimes I don't have money, but I have these rare, cards, baseball cards or coins or whatever. Like, can I use that? Well, of course you could use it, but you have to show where that big chunk of money came from. And if you show it came from rare coins and it had an appraised value, or a baseball card that has appraised values, or an antique that has an appraised value, great. If it's your something weird, then no. Right? It has to have the appraised value.
You know the seasoned amount of money? Like, for instance, that example with the mattress. You put the money, you pull out your mattress, you put it in, let's say January 1st. Once it sits in the bank for 2-3 months, is it now considered no longer mattress money?
Talk to your lender on that. I think it has to be there for 2 months.
Okay.
But I think it's a huge chunk they may still ask, an underwriter will have to approve. Because they don't want to make sure you just didn't take out a second loan and that's silent and nobody knows about it and you have to pay it back.
Oh, gotcha.
It might be like a year, I don't know, off the top of my head. I'm not a lending expert, but I know enough about lending to get by, right? And so it's for everyone needs to be, you need to know enough about lending to get by and talk to I'm not sure, let me ask the lender. All right, I'm not a lending expert, I'm a home expert. All right, I'm not a 401k expert.
I just forgot about it.
I'll bring it up. All right, that's appraisable assets. Pledged assets mortgage. So now we're getting tricky in here, all right? So what's a pledged asset mortgage? Pam. Oh, Pam. So let's say you have an asset of something else, of a CD, or CD is a good example. That's easy to do.
CD?
A CD.
CD account.
CD accounts.
You've never heard of that either?
I was thinking a little CD.
You're like, man, we're MP3 players now. What are you talking about? We don't use no CDs. Oh, young guys. All right. So what a CD is basically you put money into a bank, and let's say they give you used to get better rates, now they get terrible rates. But say they give you 2%, you put $2,000 or $10,000 in, you get 2% back, but you can't get the money for a year or something. Right? Banks do that because they pay 2% and then they charge 6% to loan it. So you get money from you by giving you back less, give it out over here and charge you more. That's how banks make money. Make sense? So let's say you have some CD assets. Nobody's doing CDs right now because the rates are so low. You used to get better rates. People would do it over time. They're safe. It's a safe investment, right? So let's say you have $100,000 in a CD asset. You are able to pledge assets to mortgage. Pam, you're pledging 30% of that asset as your down payment to the bank. And banks may be able to approve that asset. That make sense? Let's say you own a bunch of stock. You're pledging, you have $200,000 in
Bitcoin.
I don't know if Bitcoin, that they probably will nowadays, I don't know.
Yeah.
But let's say it's Tesla. And you have $200,000 in Tesla and you're going to pledge $60,000 or it's a percentage of the stock as the asset. The risk there, obviously, if Tesla takes a huge nosedive, you'd still you'd still be on the hook. But that asset, if you cash out, you can pay that towards that. Make sense? So it's a pledged asset mortgage. PAMs. Now you could ask the lender, do you guys have any PAMs? Right? So if your people has assets in something, let's say you're one of those kids that made millions on GameStop because you're followed the Wall Street bets and you made some $10,000 bet on GameStop and you made $200,000, right? You might be able to use that money towards it without having to pull it out with tax implications, right? If I pull out 60 grand from that account, I'm gonna have to pay taxes on that capital gains, right? But if I can do a PAM, it's an option.
So you're giving that interest to them to pull at a later time or
You're basically pledging it, and so if you default on your loan, they're gonna be able to take that asset, right? They're gonna be able to take that person, that money in there. So, once again,
I'll give you this.
most banks probably aren't going to do this. Actually, a lot do, believe it or not. It's not as exotic as you might think. If you read through the solution, it says Fannie Mae, for instance, has a PAM program. Fannie Mae does. It's not used very often. Other investment banks offer PAMs, but against their top popularity list. But for those who qualify, PAM makes more sense than other loans out there. It just depends on how good the asset is. And the bank looks at the asset and goes, hey, look, I can make claim to that asset. Yeah, sure, I'll get my money. Crazy stuff. Oh my gosh, we're almost out of time. Time flies when you're having fun, right? Equity transfers and bridge loans. All right, equity transfers. So the buyers have a current loan balance on the primary residence of $85,000, and the house is valued at $185,000. By using equity in their primary residence, they can buy their new home. Equity in the property, be it primary residential rental, can be capped in two easy ways: an equity loan or a bridge loan. We call them HELOCs.
Oh,
Home equity line of credit. HELOC. I own a home. I want to buy a rental property. Oh my God, this is a good time to go invest in that money. When Keller Williams was considering going public, I was strongly considering pulling out a big HELOC loan and just putting it in, because I was like, man, if we're going to get it on a discount, you know, as the market shifted, it's, 50-50 if we actually go public now or not. But I was like, I'm all in. Like, I'll take that risk, because I wouldn't mind making a couple million overnight. Right. So basically, if you have equity in the home, I bought my home for $300,000. Right now, it's worth about $550,000. So I have $250,000 in equity. Right. I can pull a HELOC. Basically, it's guaranteed for up to like 10 years. You get approved. At any moment, I can go buy another home, $250,000. Now I have a rental property. I have to pay that HELOC back. I have that loan already approved. The interest rate might be a little bit higher, but I have to go through the home loan process, and now I bought a rental property.
free and clear.
Free and clear. But I have a HELOC I have to do. I have to pay back, right? So I'll be paying back the HELOC from my rental property, my rental income. So HELOCs are great for investors. How do I get my first investment home? Guess what? If you own a home, you have equity, let's do a HELOC. See if you get approved.
What is the HELOC stand for again?
Home equity line of credit. Bridge loan's very similar. It's almost the same as a HELOC loan. I'm not going to spend too much time because I only have a couple more to get through, and I only have a couple minutes. Down payment sources and gift funds. So getting creative with your down payment sources. So gift funds, we talked about this a little bit already. The newly led couple has just returned from their honeymoon. They begin to look into buying their own home. They both read about benefits of home ownership, but they can't afford it. Solution, they could ask their family members. Buy their first home and they say yes, their requirements and gifts must be met. Those requirements aim to verifying the source of the gift fund. It's really important that it's a gift, but it's just basically boom, you get a gift. That's how you do it. Who's going to give somebody a gift? I'm not. That's crazy. Next one. Non-occupant co-borrowers. What else do we call those?
Co-signers.
Co-signer. Please, for the love, don't ever co-sign for anyone. Yourself. Right. The only time I think it's okay is you're co-signing for a child and you're okay with taking over the home as a rental if they screw it up. Please, because you now are on the hook. If you co-sign for a friend to buy a car, guess what? That's against you. You go to buy a home, now that car shows against you and you can't buy a home. Please don't co-sign. That's stupid. Saying that, I love my kids, little bastards. And if they get to a spot, oh, sorry. Motion your earphones. Oh. Good trouble. I apologize. Don't tell them I said that. I love them. They're great. Right? I would probably do that for my kids if the time was right, and if I was willing to take on the payment and keep it as a rental if they couldn't pay it. That's the only time I'd be willing to do it. Right? Because co-signing is basically now your income. You're on the hook for the home. You just don't live there. Don't co-sign for a friend. Don't do that, please. All right. Employer-assisted mortgages, EAMs. So there is actually programs out there for some. You never know. Talk to your buyers. Ask if they have any employer-assisted mortgage programs. Basically, the employer will have a program or something to help get them into the home. Either from maybe from their 401k loans, they have a special loan from the 401k that can help them do it. Down payment assistance programs or direct lending from their own employer. Like their employer now acts as a bank to help them get into a home. So you want to ask, especially these big companies that work out, Lockheed, Northrop, you want to ask these questions. Is there anything like that? A lot of the times they do. Have them call their HR department and see. There is a lot of programs that they do they probably don't even know about. So you want to say, hey, let's ask. There might have some great program that your place offers. All right, I got through it. We're gonna skip the lenders, what lenders can do, because guess what? You're not lenders. Now, I would encourage you guys, this is a lot, right? It's a lot to read. And basically, I explained it in the easy sense. Go back and read the ones that you're interested in, like might want to learn more about. Read through it, it gives great examples on there. Read through the lenders as well, because you never know, the lender may have something in there that works out well for them too, that they didn't think about, and now you can let them, hey, is this something that you can do? Was this interesting?
Yeah.
Did it make you think like, oh my gosh,
He did, I didn't even watch it, oh my God.
you, George is shocked. George can't even comprehend what's going on. So, our next shift class, guys, it's broken up into 3 parts, and we may have to extend this out another week, because I don't know if we can do all 3 parts in one day. It's hard enough to do 1 part in a day.
What's tomorrow?
Yeah, I'll have to get with you to see if it's, which one's that. But anyways, I hope you guys enjoy this. Now it is time for track. So I'm gonna get out of the way for George, and George can do his thing.
Awesome!
See you guys later.
Thank you.
It's hot in here, bro.
It's getting hot in here. Please keep on all your clothes. Please keep
Good morning!
Morning, morning.
How's everybody doing after this wonderful session of shift? Ready for some track? You can stay for track.
I can, but I'm not.
Whatever's.